you have a lot of shares that have been neglected because the attention has focused lately at, say, the speculators are all in meme stocks and in cryptos. So gold and silver and platinum have been neglected as an object of speculation. Similarly, in the market, you have the US, the FANG and related stocks and semiconductors that are very high. But at the same time, you have emerging markets, some of which are quite depressed, and some of which have economies that actually in the long run look reasonably good.
Thanks for joining us for part 2 of our interview with global macro analyst Dr. Marc Faber. If you haven't yet watched part 1 of our discussion with Marc, in which he explains why historical precedent virtually guarantees harder times ahead for the global economy, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment perspective that Marc and our partners at New Harbor Financial share in this video. Oh, and if you haven't yet, don't forget to subscribe to this channel by clicking the red subscribe button below, as well as that little bell icon right next to it. It only takes a second and it really helps us out, as the more subscribers this channel has, the more big name experts we can attract onto this program in the future. And now, here's part 2 of our interview with the incomparable Dr. Marc Faber. I remember following your work, right before and right after the global financial crisis. And I think you were still pretty pessimistic back then about our prospects. But you had said, if you got to keep your money in the system somewhere, you got to do something with your money. And I recall that you kind of said, look, if you put a quarter of it in global equities, a quarter in global bonds, a quarter in precious metals. I can't remember if the other quarter was real estate or whatever it was, yes. Real estate. And that actually performed pretty darn well over the past 10 years. Do you have any sort of general framework like that, in the near term for folks to consider? Or is this the time to put it all into precious metals and ideally precious metals nobody knows where they are?
I wouldn't put everything in precious metals because if we look at the performance of assets over very long periods of time, stocks have tended to outperform precious metals. But I think we need to select stocks relatively carefully, because what is interesting in the market at the present time is you have some stocks that are very expensive and high. They are like the stocks that were the favorite stocks in 1973. They were called the Nifty 50. These were 50 stocks in the US, like Kodak, Sears, Polaroid, Xerox. Most of them by now have gone bankrupt, but at the time, they were the most popular and safest investments, okay? And we have to be careful. These stocks are not particularly cheap, so they may come under a lot of pressure. On the other hand, you have a lot of shares that have been neglected because the attention has focused lately at, say, the speculators are all in meme stocks and in cryptos. So gold and silver and platinum have been neglected as an object of speculation. Similarly, in the market, you have the US, the FANG and related stocks and semiconductors that are very high. But at the same time, you have emerging markets, some of which are quite depressed, and some of which have economies that actually in the long run look reasonably good. You understand, China is not going to grow at 10% per annum anymore, nor will India, but they can grow at probably 3-4% per annum. And some companies that are well managed will do well. Similarly, in Indonesia, Indonesia is not a small country, over 200 million people. Same Bangladesh, same Pakistan. So the world is a huge place, and some countries, in my opinion, will do relatively well because the countries, especially that had socialism, they will never want to go back to socialism. That I guarantee you.
Interesting. So just to ask a specific question there. So there is a case that people make for emerging markets right now being fairly undervalued relative to US and
Certainly
European stuff.
relative to the US.
Yeah. And what you're saying there is a number of those countries, are still in the process of opening up from communist totalitarian rule. And to your point, that once they've tasted this greater freedom, they're never going to go back. So are you generally, I'm going to use the term bullish because I don't think you're necessarily a bull on anything, but are you more optimistic about emerging markets going forward?
I can answer this question by saying that of the asset allocation that I have to equities, which is approximately 25%, and 25% precious metals, and 25% real estate, and 25% bonds and cash. Of the 25% allocation in equities, I have probably 80% in emerging economies, and maybe 20% in European value stocks.
All right. Well, that is super useful for us, Mark. So, Mark, I'm looking at the time, my time, and realizing how late it is, or maybe early in the morning it is, your time in Thailand. I can't thank you enough for taking the time to come on with us and share us your deep seasoned expertise. Before we wrap up here, for people that want to learn more about you and your work, perhaps follow you going forward if they didn't know you before this video, where should they go?
I think most people don't want to learn more about me.
Not at all.
But I have a website to subscribe to my papers called gloomboomdoom.com, all in one word. Or if you Google my name, you'll find me somewhere.
All right. Well, look, we'll put the URL up on the screen during the editing process when you read the gloomboomdoom.com URL there. Hey, one real quick, I realize I'm going to get a ton of messages if I don't ask you this. You've talked about cryptos briefly, once or twice here. Just want your 60-second opinion. But, some people would say, hey, that's a good way to A, protect against currency devaluation, and B, be able to move your capital across borders. Are you in favor of cryptos? Do you have major concerns about them? Where do you fall on them?
I think that the way we pay today with a banknote, like we have a wallet and the banknote and so on, credit cards will stay, prepaid card will stay, but this kind of fodder, that will disappear. I think we'll have cryptos in future. But you understand, a crypto that is controlled by the government is equally bad as a paper currency that is controlled by the Federal Reserve, that is controlled or was formed by some leading families in the world.
All right.
So we have to, you always have to choose. Who do you want to control your money?
In charge of your currency supply, absolutely.
The beauty of gold and silver is that nobody controls it. Unless the government says, well, you can't own it. The US has done it before. I don't understand how the US can always broadcast to the rest of the world to being the land of the free. After 1933, gold was illegal in the US.
All right. Well said, Mark. And look, thank you so much for the time you've given us. Really appreciate you coming on the program. I'm sure we're going to have a lot of folks asking to have you come on again in the future. I hope that's all right in your book. And please go get some sleep. Thank you so much for staying up so late for us.
My pleasure. My pleasure. Bye-bye. Bye-bye.
All right. And now, as I do every week on this program, I'm going to talk with the lead partners at New Harbor Financial. Mike, John, Marc Faber, man, you do not have any questions about where that guy stands on the issues he talks about. And definitely he's got some, very stark, very frank, very hard-hitting opinions. I want to ask you guys about some of his commentary around gold, emerging markets and whatnot. Real quick, guys, I know there's a lot there to respond to, but What are some of the key takeaways you took from what Marc said there? John, why don't we start with you?
Marc's always a fascinating listen. He certainly has a lot of history and context and perspective that he dives deep to bring to the table. Really appreciate his comments. Sometimes we even in our seats can get lost in the day-to-day and the minutia of the data, and sometimes you got to take a step back and really look at things in the bigger cycle and even in the historical cycle. These mistakes have been made before, and there's been lessons that should have been learned, and I think he properly kind of teases out some of those. Give Marc due credit. He is a very confidently spoken. I won't say outspoken, because I think he calls a lot of truth to the table, and it's very refreshing sometimes to hear someone outside the U.S. kind of looking back inward. And I'm as patriotic as they come, but we all got to take a good look at the realities and truths of what's before us.
Yeah, and that's exactly why I brought Marc on. It was sort of for two main reasons. One, he's got that global perspective, based there in Thailand, and looks at investing opportunities all over the world. Doesn't just get caught up in what's going on in one place like the U.S. market or Europe. But also he is that student of history, both economic history and political history. Spent a lot of time in socialist countries, and so is not just speaking academically about his conclusions. These are things that he's seen unfold over the course of his lifetime. John, I actually want to stick with you for a second here and just talk about a chart that you sent over here before we started filming, which was a chart about emerging markets. I know that's one of the positions in the New Harbor portfolio. I know it hasn't performed that great over the past couple of months, but Marc made a good case for why investors, particularly investors in developed countries, should consider geographical diversification in general, but also looking at the emerging markets. And he's so confident that he said that of the percent of his portfolio that he has in stocks, about 80% of that is in emerging markets equities. So let's pull this chart up here, which says that the emerging market equities are approaching a 20-year low versus the S&P 500. And John, why don't I let you take over the football here and sort of tell me why you sent this over?
Yeah, this chart is obviously a very, very big picture. It's a lot of historical context. This chart goes back to 1987, right through the present day. And, it was put together by Bank of America with some data from Bloomberg. So it's an authoritative source. It basically just shows the relative valuations of emerging market stocks as compared to U.S. stocks. If nothing else, this speaks to the long cycle of things and the fact that cycles eventually do turn. And when they do turn, they turn in a usually lasting and very dramatic way. So this shows, kind of in this long history of back to 87, we're approaching near record lows of emerging market stocks on a valuation basis versus US stocks. This is a position that we have observed for a number of years now, and these cycles don't turn on 1 or 2 year type timeframes. These are oftentimes 10-year trends or longer. So categorically, if you look at data, emerging market stocks are much better valuations than U.S. stocks, which have never been more expensive than they are now, not even close any other period of time. So we are relatively more attracted to emerging market stocks. Other folks out there are as well. GMO, big Boston-based investment manager, Jerry Grantham's firm, have long espoused in this current cycle the tremendous relative undervaluation of emerging markets. There is the demographic thing. Most emerging markets have younger, growing workforces where growth and prosperity and ambition, you might even say, are a little bit different than some of the developed economies, where the workforce is aging, the governments and economies are getting saddled with tremendous amounts of debt and entitlements and things like that. But there are also things like diversification out of the U.S. dollar that is benefit. If we do kind of further kind of experiment with policies that can undermine the U.S. dollar, emerging market stocks should do relatively well. And they also have a resource natural resource kind of angle to them. A lot of these emerging economies are natural resource rich, and to the extent inflation takes hold and commodity prices go higher, that should favor on a relative basis emerging market stocks. So sorry for the long-winded response there, but
no, it was actually a great summarization. So thank you. I want to stick with you to get to one other chart you sent over, and then Mike, I'm coming to you to talk about gold. But before I do, John, if viewers here are interested in looking at ways to get exposure, increase exposure to emerging markets, do they have to go out and sort of research individual companies and kind of build their own position, or are there funds, ETFs that make it easier for the not too familiar with emerging markets investor to begin to dip their toe in?
Oh yeah, absolutely. There are many, and I'm not going to endorse any one here. Probably run afoul of some regulatory things. But yeah, but when we do invest in emerging markets, we're not picking individual stocks. We don't. We're looking. Not only do we have the on the ground insights to look at those stocks, but we're looking for the asset class, the broad asset class exposure relative to other things that we're either under or unweighted to. So yeah.
All right. And sorry, just to dive into that as well, I'm assuming the case, but you tell me right or wrong. You can certainly buy a fund like a China fund or whatnot, where you're buying for a specific market. But I assume there are funds too where you're getting country diversity inside the ETF or the fund itself too. Is that correct?
Yeah, there are broad emerging markets funds that cover Asia, South America, emerging Europe, you name it. A broad swath. In fact, there's an index. I forget who the index, but the emerging markets index. Is a. Let me see if I can kind of get the actual name of it.
All right. Well, look, where you're pulling it up.
MSCI. MSCI is
MSCI. Okay. Yeah.
Emerging market index.
Okay. Great. So you also mentioned there that these stocks are approaching a 20-year low compared to the S&P 500. The S&P 500 is back up at an all-time high, as is the Dow, as is pretty much the NASDAQ. So we are back to full party on in the major market indices. You sent over a slide here. It's a slide from John Hussman. I know we've brought this slide up in past shows, but it's basically showing that given the high levels of valuation in current markets right now, the projected forward return of the market is about as low as it's ever been. Can you comment on this?
Yeah, this chart, if you have it up for folks, it's a scatter plot. Each one of these dots is an data point that has been observed. It's no one's guess. John Hussman isn't getting he's a great analyst, by the way, one of our favorites. Always want to give him plenty of kudos and credit because he does great work. But each one of these dots is an actual observed 12-year annual return in the S&P 500. So again, no one's guess. This is actual data. And what it shows is anybody that's a statistics, even remotely familiar with statistics, it shows a very tight, what's called a scatter plot. And it shows the horizontal axis is a metric of market valuation relative to a really robust fundamental called gross value added. It's kind of like a price to earnings ratio. Bottom line is, as you get further to the right on the horizontal axis, stocks are becoming more expensive relative to that underlying fundamental. And as you get to the left, they're getting cheaper. Okay. A couple things to note here. There's a huge, very, very tight relationship. The higher valuations are at a given point in time, the lower the subsequent 12-year returns are. It's a simple law of the financial universe. Okay. So right now, if you look at the arrow to the far right, the measure of this ratio right now is 3.46. If you go vertically from that to pick a return that you want to assume for the future. If you want to assume 10% annual return from today, take that point where the 3.46 is and go vertically until you get to 10% on the vertical axis. What you end up there is a data point that would be so outside the norm, such an outlier relative to all history. It really paints a vivid picture. Even assuming a 0% annual return from current levels, which most people that are in stocks certainly aren't investing for zero, that too is a very dramatic outlier from any history. This chart suggests that it would be reasonable to expect, if this relationship were to hold like it has in history, a negative, almost 6% annual return over the next 12 years. Annual, not just cumulative, annual.
Annual return for 12 years.
Yeah, and to ask the question another way, what kind of valuation would be historically consistent with, say, a 10% annual return? Well, go to 10% on that vertical axis and go horizontally until you get to the middle of that. That would suggest a ratio of about 1.0. Okay, that suggests we're 3.5 times more overvalued today. So that's like a 70-ish% drop to get to the level that would be consistent with kind of the historical valuations that would be supportive of 10% annual returns. This is crazy stuff where we are right now.
Okay, so that is the embedded risk in today's market prices. We beat that drum a lot in previous videos, so I won't go too deep with it here with you guys. But I just want to update folks here, because that's why we have you guys on every week, is to show folks where things are as of today. We are about as stretched in valuation terms as we've ever been so far in this story. Okay, Mike, I'm coming over to you now. Mark talked a lot about gold. Gold, precious metal, is still something he's a strong believer in. He still has 25% of his portfolio in it. Gold prices have not done very well recently. In fact, they really got beaten up over the past week, where the jobs report came out last Friday. Better than expected. So that made people think that the Fed might actually start tapering or tightening sooner, which made rates go up a little bit, and that sent gold down. And then a few days later, Sunday night, in the thinly traded markets, somebody dumped $4 billion worth of gold futures contracts within a matter of minutes on the market, creating a flash crash in gold. Gold's recovered from that a little bit. But I'm going to put up this chart here that you guys sent over, which is showing that relative to a general commodities index, gold is looking extremely cheap right now. In fact, almost the cheapest it's been in, over the past decade or so. So a lot of interest in gold, both from Mark's comments and I think just from our audience in general. What's your guys' take on what's going on right now?
Yeah, we're not happy to see the move in the precious metals market that's happened over the last couple of weeks, and certainly the flash crash Sunday night was pretty surprising. Where, like you said, $4 billion notional of gold was dumped in the nighttime Globex electronic markets. It's recovered a good portion of that. I'm looking at the chart right now. Gold has really been in this giant consolidation range for a few years. It reached a high, as many people might remember, August of 20. And since then, it's been on a pullback, but it's basically in this giant triangle formation. This drop on Sunday is the first thing of real concern, in that it broke to the downside out of this triangle. Triangle is a technical formation where prices start to consolidate and then squeeze down, and they compress into a tighter and tighter range until they break out. Well, gold broke out to the downside and touched 1677 or so in the futures market. That would normally be a bearish. It would be a bearish indication, because it broke out to the downside out of a consolidation. Interestingly, though, in the last couple of days, the price of gold has come right back to the bottom trend line of that triangle, sitting at around 1753 right now in the futures market. So there's a big support shelf right there, right around 1750, 1760. It's pretty precarious, particularly in the backdrop of the dollar. The U.S. dollar's been in a range, and it's more recently been trying to break out to the upside of that range. So something else we're watching pretty closely. The dollar's been kind of trying to break out above the 93 range, and looks like it may be successful in doing that for the next couple of months. Having said that, I don't think it's impossible for the dollar to get stronger and for gold to get stronger. The correlation is not as close to one as you might otherwise think. But from a pure technical perspective, in my view, gold will have to get above this area pretty quickly, or it risks, from a technical perspective, rolling over and going down below 1680 or so. So it's tough to say. I mean, mining shares, which we are long-term holders of and believe in, are undervalued, we think. There's a lot of good things that have happened in that sector, like restructuring of debt. They're hugely profitable. The mining companies are, even at $1,600, $1,700, $1,800 gold. And they're trading at valuations that are really low compared to the S&P. So we really like the mining shares. We like gold too. We'd like to see it rebound quicker from here so that it was a false breakout to the downside. If that were the case, it's almost like a boomerang where it fakes out to the downside and then can start to accelerate to the upside. We'd love to see that, but again, it's pretty tenuous right here at 1750 or so. We need to see it go above 1800 pretty quick, hopefully.
Good points, Mike. And I just want to add to that by saying that the vast majority of experts that we've had on this program, including Mark, are all fairly united in assessing the precious metals right now as being highly undervalued relative to virtually every other asset class that's out there. All right, so folks, if you're watching and you are concerned by the major warning flags that Mark discussed, and trying to figure out how to safeguard your wealth given what might be coming down the road. If you want to talk to a professional financial advisor, get their counsel of somebody who sees the risk that Mark talks about. If you're new to this program, you might not know that Mike and John and the team at New Harbor offer free personal financial consultations to the viewers of all of these videos. It doesn't cost anything. There's no strings attached. There's no commitments. They're just trying to help people position themselves as prudently as possible while there's still time to do so. If you're interested in that, stick around to the end of this video. We tell you how to do that. All right, if you want to see more great guests like Marc Faber and the folks that we've had on this program recently, Lance Roberts, Michael Pinto, Stephanie Pomboy, Grant Williams, Luke Groman, Lynn Alden, huge long list of these folks, help us out by doing two quick things. One, hit the like button on this video, and then if you haven't already, please click the subscribe button as well as that little bell icon right next to it. Those seem like small things, but they really do help us out in attracting big names on this program going forward. And if you'd like to see who we're going to have on this program going forward and maybe give your own advice as to who we should bring on, just follow me on Twitter at Menlo Bear. All right, John and Mike, thanks again for joining me for yet another great week of making sense of these markets. Who knows what's going to happen from here, but as it unfolds, we will be making sense of it for our viewers together here on this program. Thanks so much for joining me, guys.
Thank you, Adam. Talk to you next week.
Thanks a lot, Adam. Always a joy, and good work getting some well-known guests on. Keep up the good work. Thank you.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to Wealthion.com. These consultations are completely free, and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.